Okay, it says I'm live. Let me check my internet connection, make sure I'm on the right. Yes, I have two fiber lines coming in, one shared with everything else, one is private to me. And a few seconds for people to show up. And then I'll begin. We have one question already loaded up. Why don't we begin with that? At what rate of unemployment will get feds to become concerned if they allow the current rate to remain longer? Inflation is sticky. I believe the feds are too data dependent. He was asked that in the press conference. Right at the very end, Yahoo Finance said scenario where unemployment is over 4% and inflation is over, excuse me, my neck is a little tight, over 2%, what would you do? And he said, his answer was, it's an unexpected increase in the unemployment rate. So if rates were held higher for longer, there's an expectation that the unemployment rate would go up. They would not be concerned with that. It is an unexpected increase in the unemployment rate. So I wouldn't look at 4% as a line in the sand on this one. It would be, let's say in a given month, we go from 3.9 to 4.4 with some job losses, and then you go to 5.1 with more job losses. That's an external event. That's something that happens externally that causes a big dislocation. When you have a curve inversion from the 3-month to the 10-year, external events cause, I wouldn't say more damage, but cause damage faster because of the fragility of the system. Liquidity dries up super fast in a condition like that, which then causes a cascading of more issues. You said JP Morgan is managing wealth now. Why did you choose them over managing yourself? If you are managing money at a sponsor level, let's say a pension fund, and you have an allocation to hedge funds, let's say, you always have diversification of managers. So you never put all your money in just a one hedge fund. You have diversification across managers. Me managing the whole thing, especially when the portion that's being managed, the amount, the percentage of the total that's being managed is for someone else. I'll be giving that away because I really don't need it. So it's slated for a university, or well, maybe two universities for research shares. So I'm more of a caretaker on that. So it's important to have external management as opposed to having just me and my one strategy on everything. It's too large for me to pay attention to on a daily basis. So it's better to have somebody else take care of it. Once you get to a certain size, it's not a part-time thing. Asset management then becomes a full-time job because you have to have diversification and you have to find a home for everything. That takes a lot of research. So what I do is scalable if I dedicate 10 hours a day to it every day. It's not a part-time thing. Can I ask about CFA? You can. What would be the implication of lowering interest rates by Bank of Canada have on residential housing prices? That's a good question. On the one hand, you would increase builders' willingness to take out construction loans because they can see that the trajectory is going down. So if they take out a 1-year or 2-year construction loan, and usually these construction loans are paid out by the mortgage. When they sell the house, the mortgage that comes in pays out the construction loan. If they see that rates are coming down, they're probably more willing to take out construction loans. You might actually get an increase in home construction for spec homes. You might get an increase there. You may get, it really comes down in Canada to the 5-year yield, because mortgages are based off the 5-year, because most mortgages that are fixed are 25-year fixed with 5-year renewals. So you have a 5-year fixed rate, and your mortgage just renews. You don't have to get a whole new, it just renews at a higher rate. So you could have a situation where rates come down, the floating rate comes down, which would help the cost of construction loans, but that the 5-year doesn't really move. So you're basically getting an uninversion of the curve when the short rates go down and the 5-year stays the same. You could have the same mortgage rates, but lower construction loan rates on the way down, which would not encourage demand, but would encourage supply. It's a narrow window. You have a shortage of housing. You're putting more and more people into a country that has a shortage of housing. Supply and demand, price can only go one way. So price would go up. And CMHC is calling for a price increase as well, saying the level of activity won't be as feverish as pre-pandemic, or as feverish as early 2022, I should say, but that prices will exceed that level. So when you have a shortage and you are bringing in way more demand than supply, and you have a supply constraint like the cost of funds, you just make a bad situation worse for buyers, but you make it great for homeowners. And 70% of the Canadian population, 66 to 70%, are long housing. So housing going up is not a big deal for them. It's actually, it's actually good. The greatest good. What do we have here? What's the perfect scenario for the 2024 election in your opinion? Is there a perfect scenario? Is there? I don't know that there is. You're looking at two contrasting ideologies. You have a small group of people that want the Democratic ideology. You have a small group of people that want the Trump ideology. You have a much larger group of people that do not want the Democratic ideology, so will vote for Trump. And you have a large group of people who do not want the Trump ideology that will vote for Biden. I don't know that you have, I think you have a minority of the population happy about their candidate, and the vast majority of the population unhappy about either candidate, but unhappier than one over the other. Both will have deficit spending. One will have deficit spending with higher taxes. Another one will have deficit spending with lower taxes. So if you're a successful person, perhaps you want Trump, but that doesn't change the situation in the economy for anybody in the future. It just makes the debt even worse. That at some point it has to be dealt with. At some point it has to be dealt with. The Democrats are more likely to raise taxes to pay it off. The Republicans are more likely to encourage growth and hope that we can grow our way out of this. Trump is more likely to just say, we're not paying you. You, China, we're not. I don't think any other president would do that, but I wouldn't put it past Trump to decide for a particular country, we're just not paying you. Tough. Sue us. He has a long history with not paying, so it's down his alley. I don't think there is an ideal situation or a perfect situation for 2024. Both of them get very sick and incapacitated and cannot run. Both parties then at the last minute put forward centrist candidates from both parties. There's a hope. right? I mean, they are old enough. I mean, maybe they get sick. Maybe they don't make it. Maybe the parties elect somebody more centrist. A lot of maybes in there, like New Jersey maybes. Maybe you don't make it to work tomorrow, you know? Which is the added value of platforms. They're really expensive and require a lot of money. The added value of platforms like Pershare versus Interactive Brokers really expensive, require a lot of money. You're going to have to be more specific about what it is you're buying from Interactive Brokers. How do you price in geopolitical risk? Well, I don't know if there's an absolute way of doing it, more as a relative way of doing it. So let's think about this. You have a market, the S&P 500, with pushing up now almost 50% of its revenues are global from outside the country. And something happens in, let's say, Manchuria. Who cares, right? It doesn't affect anything. So you wouldn't have to change anything no matter what it is. But something happens in a critical supply route where there is, I don't want to say a critical material, but let's say it's either oil, which is the big one, or just a critical supply route. Then whatever multiple you have, being that you have increased risk, the multiple should be lower. On a relative basis, it should be lower. How much lower, I don't know, but it certainly shouldn't go higher. If you have new geopolitical risk and the multiple on the market goes higher, one of two things. The market does not recognize that geopolitical risk has anything to do with anything. That's why the war in Yemen has gone on for as long as it has, because who cares? From an economic perspective in the developed market, who cares, right? Those lives really don't matter because they don't affect economic output. But if you have lives that do affect economic output, oh, well, then all of a sudden there's this big moral claim of we can't let this continue. So either the market is just not recognizing it as a risk, or the market's wrong. Markets don't have to be right. There's nothing in the efficient market hypotheses that says the market is right. It just says the market is efficient. Efficient means that when there's news, it gets priced into the market very quickly, that there's no impediments in pricing it into the market. That's all it means. That doesn't mean that the interpretation of the data was correct or that the market is correct, only that while they priced something in, I think they're wrong. That's what makes a market, is even in efficient markets, the market does not have to be right. It can be wrong. Your market outlook showed that Jay Powell doesn't think there is stagflation. Well, those are his words. We don't see the stag, we don't see the flation. What is your interpretation on stagflation? Still fairly early to claim, but do you think it's something to think about? No. Prior to 1982, there was a very different rules on investing and very different rules for banking in terms of how much banks could pay on deposits. There was certain limitations where they couldn't compete with money market funds, so banks would lose deposits very quickly, which means it made it difficult to make loans to grow the economy. Also, there was a limitation on what pension funds could invest in. After 1982, up to 5% of pension money could go to venture capital. So that really created an explosion of investment in new businesses that have the potential to contribute significant economic growth, and then banks could start paying interest on deposits so that they could keep deposits to make loans. Being that that was a move towards greater capitalism and as such more resiliency in the economy towards things like stagflation, you can grow your way out of these things. I don't know about growing your way out of debt, but you can grow your way out of stagnation. The 70s was a very unique period of stagnation. Have a look at, and this is just one indicator. Google a typical washing machine in 1971. See if you can find a brand for a washing machine in 1971 and a brand for a car in 1971. Not the Cadillac or Corvette, but let's go with any Buick, for example, in 1971. Then go to 1978 and Google the same thing. See if you can find the same brand. And then look at the list of characteristics. They didn't change. Lost decade of innovation. I think it was called Stagnation of Innovation by Mensch, M-E-N-S-C-H, and talked about that decade as being one in which there was just nothing. It just went sideways. We don't have that now. We had that then because there was a lack of capital available for reinvestment, simply because money was leaving into money market funds. It was leaving, and pension funds and a lot of institutional money was restricted from investing in this nascent field called venture capital. It wasn't until the 80s where that really started to explode. There was also a change in the patent law around 1982 to 1982. Research conducted in universities on government money. The government owned the patent. But governments were terrible at technology transfer, transferring that technology into the marketplace. After 1982, government said, okay, even if we put money into your research, you guys own the patent. So universities, and especially the scientist professor that worked on the patent, along with venture capital, became far more successful at technology transfer. So early 80s, there was a lot of things that happened in the banking sector as far as investments go in into venture capital and the change in that patent law. We have all of that in place today. So the pace of technological change is far more rapid, and it creates opportunity, consistently creates opportunity, because you've left it to the free market now. You've let the free market go on where you can invest your money and where the emerging markets are. Governments are very bad at picking that. For example, in the late 70s, governments spent a lot of money propping up the textile industry because jobs were being lost to South America, propping up textiles, propping up the Rust Belt, and didn't put one single penny into biotechnology or the emerging Silicon Valley area semiconductor space. Not one penny went into that. And the money that they used to support these industries eventually all failed. It was a waste of taxpayer money, but private money had it right, if we look at where the industries are today. I don't see that we can repeat the 70s in the US, given the role we've given to capital in the economy now. Are you going to be doing the poem philosophy series going forward? If you would be willing to do Shakespeare. I like Shakespeare. I'm willing to do Shakespeare. Shakespeare was poignant, not really poetic. What do I mean by that? He had a way of saying things in a few lines that captured deep moments. So he could sum up big concepts in simple lines quite nicely. But he wasn't somebody that I mean, once you understand what he's saying one thing, right? He's saying one thing. It's not as if it was, I mean, he's writing a story in poetry, but he's not giving you a blank slate in poetry where you create your own meaning within it. It's quite clear what his meaning is and what his story is. So I find that there's, other than the beauty of the language that he uses and the way that he says things, I find there's not left much for me to explore. There's not a lot of meaning in that. It's nothing that really stays with me for any long period of time. So while I'm okay doing Shakespeare, once you understand how the hell he's writing and what the hell he's saying, it's a story that's you could write it in English words, common prose of today, and it would be a story. So I am willing to do Shakespeare, but there isn't much. Even his sonnets are, structurally very good. Big language. He uses a lot of words, more words than anybody else has ever used, I think. The range of words that he uses, but there's not lots that's left for me to explore it within. You said last week you were now a tax expert. Well, with the time that I spent on my taxes, I've become an expert. I wouldn't call myself an expert in the sense that I'm ready to sell my services, but I can certainly, at this point in time, give myself a hell of a lot more better advice than all of the tax advice I've gotten over the years, because I get to certain schedules and certain lines and I read it and I say, how come nobody told me about this? Because I would have done this. How come nobody told me about this thing or this thing or this thing? There's about 4 or 5 things I came across saying, how come I didn't know about this? Where's the advice I'm supposed to be getting here? The advice I got was pay your taxes, but it can't be right. It's so much. It's right. Pay your taxes. There are some years where I paid and paid, and then you file taxes thinking, well, I paid throughout the year because you got to pay every month. I paid so much during the year. And then you get this tax bill for a couple $100,000 again. It's like, how? How is it even possible? So I think I have to go back over all the taxes that were filed, all the forms that were filed, and say, look, I'm pretty sure you're doing this wrong. How can it be? All right. But where we leave off here. What do you think about having a tax section on the applied series? Very difficult. Very difficult because every country is different. I could do it. I could do something for Canadian personal taxes. And I could do something in terms of how you would invest given what Canadian personal taxes are. But I don't know what level of income you have. I don't know if you are in the upper tax bracket and it requires much more creative investment strategies. I don't know if you're in, I really don't know where you happen to sit in all of that. How many homes do you have? That matters. How many homes you have, how willing you are to turn one into a rental, even like an Airbnb, how willing you are to get that done, because that has by the way, great tax benefits if you do that, simply because if you turn it into a business that way, your depreciation tax shield in the first few years, you're running that place at a loss, which then goes against some of your other income. So there's a lot that can be done if you're willing, but different countries, different laws, different people at different tax brackets, different strategies that you would use. So it would be difficult for me to get anything like that done in the applied series. Any downside pressure this week for TLT with Fed speak? Well, I don't think so. I think TLT has been through its paces. Got all the way to 98 at the beginning of the year, all the way back down to what we saw, 86 handle at one point. We ended with an high 88, low 89 something. Let me tell you exactly where we ended on TLT. We ended at 89.84. Sorry, just a smidge under $90. Powell was quite clear that the next move is not a hike. He doesn't see a hike. Either we go sideways or we get a cut. I think there is a limit to how long you can go sideways, given the growing debt, and given that the interest is not going to be paid, it's going to be added to the deficit, which will make the debt even worse. I think we are at the point now, given the fiscal responsibility we see on the horizon, which is none, I think you can call this the beginning of runaway debt. maybe the next couple of years, you think, well, you don't hear much about it, but unless something changes dramatically, it's going to continue on. Now, does anybody see the U.S. government reducing its debt? I don't. I don't see it happening. I don't see them reducing the debt. Does anyone see a balanced budget at any point in the future? I don't see that. So if your deficit spending and your interest cost continues to go up, your deficit's got to be wider and wider, and those add to the debt. So, yeah, I think that rates cannot go higher. And even at this level, there's a limit to how far it can go, because I'm sure Yellen gets on the phone to Powell and says, look, we can hang on for a couple more quarters at this, but we are getting to the point where this is going to get ridiculous. And keep in mind, we can't count on our elected officials. We have to do the heavy lifting here. We have to be the adults in the room, the Treasury and the Fed. So give me a second here. I have a speaking problem here. So no, I don't think that there'd be much downside on most semiconductor stocks are down. Do you think the hardware infrastructure is established and the rally is over? Well, that is one side of the argument, is that you're going to have a build out, much like you had a build out of the internet, but it wasn't a multi-year build out. It was a lot of build out and then a lot of capacity as a lot of the startups went away. Same in the AI space. You're going to have a lot of startups that simply go away. And if all of them have capacity and they start going away, like the dot-coms did, they start going away, you end up with a lot of capacity. And the build out is over. And all of those companies that were the big names in the infrastructure build out, many of them never really recovered their highs. Given the data that we've had so far, it looks like there is some leveling off to that growth rate, that perhaps we're hitting that point where, look, there's a lot of capacity now, and this company has gone away, and so we picked up their credits, and this company's gone away, and this venture capital firm picked up those credits, and maybe there are enough credits out there. And the faster these things get, the faster you train the models, the quicker you can move them over to CPUs, not GPUs, because now you're just running the model. You're not training the model. Training is what takes a lot. That's one side of the argument. The other side is that we really even haven't hit the mass adoption of training data yet. That it's the early adopters that are doing this, and you have the early adopters, and if you ever read the book Crossing the Chasm, you have your early adopters, and then you have this big valley in here where you then hit the mass adopters, and it's crossing that chasm that's dangerous. Does it happen? Do we get there? Or do large companies like Amazon, Google, Microsoft rent out a lot of space to companies that want to train their models, instead of every company building their own space? They just rent space on Amazon. As far as web hosting goes, do independent web hosting firms still exist? Like where you go somewhere and you buy a server and you host your site? I mean, anybody who's doing any kind of volume, you're doing it on AWS or Azure. I don't know that you're actually doing it anywhere else anymore. And that could be where being that has been learned, that could be what is going on in AI, is all these big server companies are saying, hey, we can do this ourselves. And it is more efficient, because then you just pay for the resources you're using, instead of big chunks of resources that you may not need 100% of, but you have just in case. Could be. It all comes down to NVIDIA. It all comes down to that. They started it exactly a year ago with their earnings. So 1 year anniversary, let's see what happens. How do you assess the external managers? What are the top things you look for? One of the things you'll find when assessing external managers is it's very difficult to find one that outperforms after fees. They have slight outperformance. Some have, there'll be a year or two where they outperform, then they're back in line, or they consistently outperform before fees, but then after fees they underperform. So the thinking is, well, why not just hold a whole bunch of ETFs and be done with it? That is a valid competing argument to use. Is to just hold ETFs, for the long run. Managers that don't outperform, managers that underperform over a period of time usually don't last very long. So if you have firms that have 10, 15-year histories, it's usually because they're just as good as an ETF, right? I don't know that you could say over the long run, other than going into hedge funds, but if you're just going into a manager for a style, large cap value, you're probably going to get over the long run some slight underperformance versus an ETF that would do it. But you might get some outperformance on some other indexes. In the end, you probably would perform pretty close to in line. And I know the question is, if that's the case, why even have active managers? Especially once you get into something like large cap value, it's hard to outperform with large cap value. There are different strategies that a manager can put in place for inline performance that you couldn't do. So you could say, look, the benchmark is this index. I want you to at least perform in line in a more tax efficient way. So the yield on the ETF or the index is 2%. I want you to get me a 1% yield and make the rest up with capital gains. So on an after-tax basis, you can outperform based on the efficiency that you get. So that's part of your strategy is the type of efficiency that you're going for. So you can still be large cap value, leaning more towards capital gains and dividends. Where did we leave off? How can I invest in options in India? No idea. Does IB allow that market? I'm sure IB would have the information for that. I've never done anything in India. Drake or Kendrick? Yeah, that seems to be a big thing. I know someone who knows someone. I know someone who knows someone, but I really do know someone who knows someone that owns the restaurant that Kendrick mentioned in his last song. Ho King restaurant in Chinatown in Toronto, eating fried rice or something like that. There was a story on it on the news, and I think Much Music did like a 10-minute segment on that. So there's something, right? So I know a little bit about it, but I'm not a fan of either one of their music. So who cares? I guess would be my answer. Any readings on systematic macro strategies? Nothing comes to mind, although I don't think that would be a literature that has nothing in it. It would start with, I think, Google Scholar. Type in those keywords and see what you get. See any if there are any papers. If not, what I find works best when I'm searching for something more serious than just a website is put in your search term space PDF, which means you'll only get PDFs back, which tend to be, depending on the words, tend to be papers that were written. Do you have exposure to China and Asia markets? I don't think so. Have you thought about capitalizing in these markets? Not really. And that's not home country bias, by the way. It is how gains and income are treated from other countries, and how they would be taxed. So when I read the literature on home country bias, I think, but you're not saying the important thing here is that most home countries have tax policies that actually deter investing outside of the domestic market. So in Canada, for example, if you get $100 in dividends from a U.S. company, the U.S. government withholds 15% of that right away, so you only get 85. You have to claim the 85 as income because it's a non-qualifying dividend, because it's a dividend from a tax-paying Canadian corporation. So your effective tax rate on that dividend is punishing. It's better to do it as a synthetic in a low interest rate environment, or just stay home and get your dividend yield at home. On an after-tax basis, it's more efficient. Same with capital gains. Some countries have laws that say, okay, well, it's capital gains on domestic property only, not international property. On international property, your gains are income, but you only get the capital gains benefit if it was a capital gain from a domestic asset. So there are tax laws that the home country bias exists oftentimes in developed markets for a good reason. Late for the party. Will we get any new poem reading philosophy soon? Yeah, I'm sort of torn between two right now, which one I'm going to do. But yeah, I am working on one. I'm trying to get the automotive sub-industry video done. I'm almost done Ford. I'm done GM, almost done Ford. Next is Tesla on their 10K, because those will be the three companies that I'm looking at. And then it's, the video for understanding the auto industry, which, I'll be honest with you, there's not a lot to understand in the auto industry. Everything in the auto industry comes down to regulation. If you understand the regulations, you understand where the automakers have to go. It's all regulation. And the big ones are National Highway Safety and Transportation Association and the EPA. And every country has their own version of it. And it's the standards they set for fuel efficiency for the fleet, for the corporate fleet. And because of it, the amount of hybrids or EVs are going to have to increase because of these standards, or these standards are going to have to be relaxed, one of the two. But if we take the standards as given, we can see where the industry has to go to. So I'm trying to get that one done first. Greetings from Bosnia Herzegovina. Bet you didn't expect to have followers here. Oh, Bosnia and Herzegovina. What happens with the derivatives if the broker goes bankrupt? All your derivatives are cleared through the central clearinghouse. So nothing happens if the broker goes bankrupt. I understand that ETF stocks, bonds are custodied, but I don't know about derivatives like options. The options are not with the broker. The counterparty to all my options is the clearinghouse, not Interactive Brokers. So nothing happens. There might be a question of what happens with my cash. Do I get all my cash back? But securities and everything, as you say, they are custodied somewhere else. Morocco, what's your opinion on the works and takes of the economist Mohamed El-Arian? I think he's a reasonable person. I think he is attempting, as of late, to position himself for a role with the Fed, just by the carefulness of his analysis, and I think he's qualified. I think he's more than qualified, but I think he's trying to position himself as a possibility for it. So, some of the things that he says, I think, are well thought out, such that he could survive a confirmation hearing. They're well thought out, so that in a confirmation hearing, he would look good to both sides. But he's got a long history with interest rates, having been at PIMCO. I mean, the yield curve drives everything you do. So I don't know how to answer that. I'm not negative on him. What are the cons of loading up on leverage and buying U.S. Treasuries? Well, leverage will cost you more than the Treasury's yield, number one. Would that not be a great arbitrage opportunity? Only for the person lending you the money. You're going to pay more than the yield on the Treasury. Simply because if the cash rate is 5.5%, the minimum borrowing cost you're going to have is 5.5%. So, sort of a general rule, you can't lever cash because that's the cash rate. That's the rate you get. That's the minimum rate you're going to borrow at. Usually you borrow at something more than a cash, like 105 basis points more than a cash rate. So you're pretty much guaranteed to lose money on that. What you can do is find a cash rate that's lower. And that's the basis of the carry trade, is you say, well, the Japanese cash rate's really low. So why don't I borrow a bunch of yen, convert the yen to US dollars, and buy treasuries? Your risk is the exchange rate at that point, because you're paying a really low interest rate and getting a really high interest rate. It's the exchange rate. Any change in the exchange rate, because that thing is levered, is going to cost you significantly. But the yen is under pressure. But you got to be careful with the yen. Ministry of Finance and BOJ have a way of intervening on that thing. But if you can find a way to borrow money at a rate that's cheaper than you can lend money, you have a carry trade. Always your mortgage, but even your mortgage now is more expensive than what you could invest at. When mortgages were under 3%, and equity markets were going up 12, 13% a year on average, there's a carry trade. But I don't know that we have that right now. With elevated cash rates, carry trades, intercurrency or intra-currency currency trades don't really have the yield, don't really have the return, not without some other form of risk. With an upward sloping yield curve, you can continually short the 1-year Treasury and use those funds to buy the 10-year, and you earn the spread between the 1 and the 10 for at least 1 year. What, in your opinion, are people so bullish about Tesla, given the challenges of implementing full self-driving technology and the increasing competition? Is there something they see that we don't? No, it's just there's something they don't see that we do, which is competition. I have found that most really bullish Tesla shareholders have an only Tesla future. That only Tesla is doing something. The idea of announcing, well, we're going to do a $25,000 car, and the stock price goes up 12%. It's like, yeah, but that's already out there, and there's going to be more of them. I mean, you're cheering that they're going to be introducing an extremely low margin vehicle into a really oversaturated competitive market. Help me out here. And you're saying, and Elon Musk says it's not going to take any extra capacity. We'll use our existing capacity, which means you have capacity that you're not going to use for the high margin cars. You're going to now use that capacity for really low margin cars. How are you going to get that done? How is that going to translate into yet an even higher multiple? It doesn't make any sense. Full self-driving is another one. Going from 90% to 100% is brutally challenging to get to that 100% level. Brutally challenging. And in between there is an army of lawyers and an army of politicians and an army of regulators who are going to get scared at you get a couple deaths. And it does not matter if you can show that, well, hang on a second. In a population of this many vehicles over this period of time, you'd expect 100 deaths. We only have 30 deaths. Doesn't matter. The fact is there are 30 deaths on a vehicle that was driving itself. Somebody's going to pay. There are going to be lawyers. There are going to be lawyers. And you're going to have an insurance industry that says, oh, yeah, lawyers. Okay, no, we're out. So the insurance industry is not on board this whole thing yet. And you're not at 100%. The gap is so wide, even though you could say, oh, but it's so good, you got to try it. Yeah, maybe it is good. Maybe it is. But it's like a gun that misfires every 1,000 bullets, and fires the bullet back to your head. It's going to kill 1 out of 1,000 people. Would you say, okay, we've got guns down, let's get this thing on the market? There's a big gap between those two things. I don't know what they're so bullish about with a CEO that performs. I'm not gonna question that. He does perform, but he has a history of over-promising and under-delivering on everything that he said. On everything that he said, he's over-promised and under-delivered. Yet here we are. Oh, October 8th, full self-driving. And I think that there are some Tesla fans out there that think that by October 9th, there'll be 1 million robo-taxis on the road. I don't know. I don't know what, if this thing were trading at 8 times earnings, I could see the bullish argument. I'd probably be making the bullish argument myself. I could see the bullish argument. But when it's trading for what it's trading at, it's hard to take the good things and make them so freaking bullish to justify the valuation. You can say, well, this feature is a good feature. Sure, but it's not this great feature that nobody else has. Everyone has it. Everyone's working on it. Everyone's going down the same road. Everyone. There is no only Tesla future, but I think that's what keeps the multiple where it is this belief that if Tesla announces something, only they're doing it, only they'll have it, only them. On every feature for Tesla, on every single feature, there's at least one car company that is better than them. On every single feature, there's at least one car company that's better than them. So they're second, third, fourth, or even fifth on every single feature that they have. Now, let's say there's a whole bunch of vehicles out there that are full self-driving, and let's say it's in 4 years. And everyone agrees, well, yeah, but Tesla's the better one. It is the better one. Let's say that it's better. It's not going to be miles better, but let's say that it's better. That everyone agrees it's a superior technology. 2 things. Number one, the history of if you look at the technology literature, is littered with the inferior technology winning. Not the superior technology, but the inferior technology winning. Number 2, a Tesla is not an attractive vehicle. It's a kind of an average looking vehicle. It's kind of like your aunt's Toyota Tercelish looking vehicle. I look at them and I think, this is not an attractive vehicle. It's an average looking vehicle. And they've been selling their modern day version of the Model T for how long now? I just don't find it an attractive vehicle. So you can say, oh, but this feature is really great on this mildly average looking vehicle. Or you can have this nice looking vehicle. It's got full self-driving. It's not as good as Tesla. I'm going to go with the look of something, if it has something that is comparable. It doesn't have to be better than it. It's comparable, right? I don't think that I would ever select a vehicle because it had more cup holders. There's a good example of, well, this vehicle has 18 cup holders. Who the hell cares, right? This one has 9. Yeah, okay, you beat me on the cup holders, but I don't know. If you own a Tesla, you're all in on it. Although I keep hearing more and more stories about Tesla owners who are unhappy with their vehicles, unhappy with the rate of time that they have to change tires, how quickly their tires wear down, the cost of insurance. You are hearing more and more of that. I don't know if it's because it's happening more and more often, or whether the media is just saying, there's a growing voice over here, let's amplify it. I don't know. But overall, if I'm on a lot and I'm looking at a bunch of cars, the Tesla is not turning my eyes. I'm not looking at it saying, wow, that's a really good looking car. And it's my opinion, right? I don't know why they're so bullish. Do you still like Canadian banks as an investment? Not TD, not until it solves its problems, the money laundering problem it has, not TD. I said this years ago in one of the CFA videos, when you're analyzing banks, you get to the part where there's, you get down to EBIT, and then there's all the one-time items that you get, and that's where you get all the bank fines. And I said, you can't treat bank fines as one-time items when banks get fined all the time. Every couple of years, if you look at any one bank, every couple of years it's getting fined for something. So that if you're projecting out earnings, you got to project a certain amount for bank fines all the time, because banks do shit for money. And TD is having some trouble right now with this this money laundering thing that they've been accused of. But as interest rates start coming down, it's a good time to be in banks when interest rates are high and coming down. So yeah, I would probably be interested in banks, but TD's got a big question mark around it. What happens to the cash in a broker in case of bankruptcy of the broker? Well, that cash should be there, but the cash is a line item. It tells you how much cash that you have, but you don't know if that cash actually exists there, because your broker can lend that cash out, and your broker can invest that cash in money market securities overnight. So your broker can use your cash, can lend it to other accounts that are using margin loans. So it may not be there. I'm not sure if there's insurance on that. So I'm thinking that there is, up to a certain number. But here's the thing: you should rarely be sitting on cash. That if you have cash, you should be in some kind of cash equivalent. 3-month T-bill, a 1-month T-bill, 2-month, whatever you can get, because they're liquid. You can get in and out of them fairly quickly, and they have no duration. They simply just pull themselves to par over time. So there should be no reason why you were sitting on a bunch of cash. So when you say I'm all in cash, you should not just have a pile of cash, because your broker is going to lend that stuff out. Your broker is going to give you about 125 basis points less than money market rates, and it's going to lend it out on margin loans at 125 plus. You're only making your broker rich. It's not doing much for you. You're underperforming. So it should rarely be the case that you were sitting in a lot of unused cash. Usually you're going to move it into a money market security, and you can move in and out. You can move in to a money market security at 2 PM, and you're out the next day if you want to deploy that cash. But especially going into weekends, if you're sitting on cash, buy whatever you can in terms of money market securities, right? In GPS GIPS, level 3, it says explain, but there's a lot of calculate questions in the textbook. Do we need to know how to? So this is something I'm having trouble with, especially with the new pathways for level 3. There's one for private markets, and we're so close to the release date, I don't think I'm letting too much out. We know that there's a pathway called private markets, and I've been through it. And I face the same problem there. Is you look at the keyword on the LOS, and then you look at the content and you think, but there's a discrepancy between the content and the keyword. Now, I am okay with a lot of calculations if it helps you discuss or explain something better. If I present you with a formula, but you really aren't going to understand the nuances of the formula unless you calculate things, then I think you should calculate things to get to that point. Black-Scholes is a good example of a formula that does not intuitively look good when you first look at it. That if I say, if this changes, what's the effect on this? You'd have to memorize all those changes. You couldn't just look at the formula and say, well, this is what would happen. So it is valuable to calculate some things using Black-Scholes, even though you'd never do that on an exam. It is useful to do it because it's part of forming your ability to discuss or explain. But what if it doesn't? What if you have pages and pages and pages of calculations, and you look at the keyword, you look at the calculations, and you say, but this is not doing anything incremental to help me with that keyword. This is just calculation for the sake of calculation because it's easy to write. And then you go to the end of chapter questions and it carries on the calculations, and you're thinking, but this in no way helps me discuss or describe or evaluate or explain. It's not formative towards that keyword. There's a lot of that. So you're left with the question, being that so much real estate is dedicated towards calculating, but no keyword is there, should we expect a calculate question on the exam? If the answer is yes, you should expect a calculate question on the exam, then what you're telling me is the keywords are now meaningless. Well, that's a terrible place to be, because if the keywords are now meaningless, how do I approach all of this knowledge? What am I expected to do? Because I'm okay being tested, but you have to tell me what I'm being tested on and how I'm being tested for it to be a fair test. Because how I'm being tested will change how I prepare for this test, right? If I said you're climbing Mount Everest, you know that you would go train on climbing, on walking hills at a very high altitude, because that's what you're going to get, right? I have to know what I'm being tested on and how I'm being tested so I can prepare for it. Now, if you say, no, the keyword is what matters above all, well, then all of these pages are useless, is what you're telling me. So either everything, and there's a couple of readings where everything is useless, or you're abandoning the keyword. And because I never get a straight answer on this, I don't know how to advise a client or a candidate towards the exam on these new things, because there is uncertainty, and where there's uncertainty, there's elevated risk. And because the uncertainty exists, there's elevated risk. I say ignore them altogether. Don't take the pathways. Having gone through them, I can tell you they are not ready. They are not ready. You will face more uncertainty on the exam, and we know, as level 3 candidates, uncertainty equals risk. I don't want higher risk. I don't want this to be my second last exam. I want this to be my last exam. I strongly recommend to stick with the content that has been tried and tried again and corrected over time. It's been perfected as much as we can expect it to be perfected these days. And I would avoid the new stuff. I don't find it incrementally useful. And some of it I find just misleading altogether. So as far as your answer for GIPS with all the explanations, the only answer I have for you is CFAI says that it stays true to the keyword. That perhaps if you look closely at the keyword and the calculating, ask yourself, after I calculate a few of these, I find that I can discuss better. Well, then it's useful. But if you say, well, I calculate these, but it doesn't help me with this keyword. Well, then that has been a waste of time. But just because you calculate doesn't mean the keyword should be calculate. Sometimes the simplest sentence to understand is a mathematical sentence. The broker's only allowed to lend shares if they've been bought with margin. In other words, bought with your own money? Correct. Are stocks bought with margins reachable by creditors of the broker? Nope. Nope, because those are not their assets. They're not their assets at all, so no. Considering current U.S. debt levels, if the Fed keeps the rate stable, how long do you think it will take the government to increase taxes? Warren Buffett on Saturday said you can expect that in the next couple of years. Taxes will have to go up to pay for this. And I've been saying that for at least the last year and a half, is that given where taxes are, they're not over. Now, who pays taxes? People who make money. I mean, if you have no income, you pay no taxes. So a 5-year-old obviously wouldn't pay any taxes. People who make below a certain amount per year pay no taxes. So it's roughly about 50% of the population that pay taxes. The top 10%, at least in Canada, the top 10% pay 43% of all the tax. Now, I want you to think about that. Only 50% of the people pay tax. So 50% pay 100%. The top 10 pay 43% of that. Where is the notion that they're not paying their fair share? To me, it seems if half the people pay taxes, the top 10% should be paying 20%, but they're paying 43%. So they're paying more than their fair share. But where are taxes going? Who's going to be paying for taxes? It's going to be the smallest voting segment, which means the most successful people. The most successful people will see increases in taxes because it's the populist way to raise taxes so that you don't lose votes. It's not the best way. It's not the greatest good for the greatest number. It is the greatest good for the party in power. And that is where we are. We're in the realm of populist democracy, not responsible democracy. We've left that way behind. I blame social media for a lot of it, but we've left responsible democracy behind. We're past that now. We're in the decadence phase, I think, where all we care about really is our side. We don't see a country, we just see our side. This is not going to get better anytime soon. So it depends on who wins, right? You get another liberal NDP coalition in Canada, yeah, taxes are going up on successful people a lot. I mean, a lot more. It wouldn't surprise me if at some point, if we continued on that the capital gains inclusion rate would be 100%. In other words, capital gain is just income. It would not surprise me at all. If Biden wins in the US, they've already put out their tax platform, which includes a higher capital gains inclusion rate, which includes a wealth tax. Well, it's people with wealth that pay it. Right? It's people who have done the right things, have earned their income, have been wise with their income. That's how you get wealth. Wealth is not about what you make. That is a misnomer. Wealth is not about what you make. It's about what you keep. So when you look at things like income inequality and wealth inequality, in almost every country you look at, there's more wealth inequality than income inequality. What that is saying is that there's a much fairer distribution in incomes, but a far different distribution in wealth. Why? Because a lot of people don't know how to keep the money they make. That's why they have no wealth. So you're really taxing those who made the savings decision. I'm going to save. I'm going to leave my money here and here, and I'm going to invest. And my investment my savings equals investment. It's going to create loanable funds for a bank. It's going to create investment somewhere else, and I will be summarily punished for supporting the economy as such. I will be summarily punished, and you will. Capital will be punished. That's what happens in populist democracies. You will run deficit after deficit after deficit. Left-leaning will punish capital. Right-leaning will lower tax rates. Left-leaning will raise tax rates or lower tax rates. Both sides will deficit spend. And eventually, that capital, at some point, you're going to lose most of it. You're going to lose most of it. That's the end game. Best, if you have capital, best to leave those countries now, because you don't get to keep that anymore. You just get to hold on to it for a period of time. The only way you get to keep it is when you make it, spend it. Spend it, spend it, spend it, because they're going to take it away from you. They're going to take it away from you. So an interesting way to do it would be, just buy as many baseball cards and hockey cards as you can every year. Just keep buying as many of those as you can. The rule for this kind of stuff is if you paid less than $1,000 for it and you sold it for less than $1,000, there's no capital gain. But you can buy a whole series of hockey cards every single year. And then after like a 15-year, 20-year holding period, those rookie cards are worth hundreds of dollars. You could do very on that and avoid the taxes. There are great ways to do it. So be real asset rich and cash poor in a regime where the government wants to tax your wealth. Just don't have any for them to tax. What do you think of payment for order flow? Well, you have a broker that is selling your order flow to somebody who will trade against you. What do you think about that? Is that fair for you? Right? I think that's an easy one to answer. Is that fair for you? Now, what if you had free trades in exchange for that? Well, now you're getting some consideration. You're saying, I don't pay to trade, but I know I'm going to get half a penny or a penny shaved off every trade I make because somebody's going to step in and trade ahead of me to the tune of half a penny or a penny. Now, if that doesn't bother you, then it's a fair trade, right? So we have to think about what we're getting in context. You're not going to pay for your trades. Rule number one, nothing is free. If you're getting something for free, that means somebody somewhere is paying for it. You just have to ask, are you comfortable with that? Are you comfortable with somebody else paying for it, and how are they paying for it? You hear a lot about my data, my data, my data. I don't want anybody tracking my data. Okay, well then pay for your Facebook account, pay for your Instagram account, pay for your X account, pay for your YouTube account, pay for your Gmail, pay for it. Because you get all that stuff free. That's the deal. You get to use this for free, and we'll get those people to pay for it. But to get them to pay for it, they kind of got to know something about the population of people we have. They're not really interested in you. They're interested in your demographic. They don't really know or care about you. They care about you as part of a bigger group. So I'll tell you what, let's track what you're doing so that we can charge these people more because we have better data, and we can afford to give you an improving product for free every year. And you say, sign me up. Well, then you don't get to scream my data, my data. That's the deal you made. You get this free. We get somebody else to pay for it, but we got to give this somebody else something. They're not just going to pay for it because you're a wonderful person, right? So payment for order flow, Robinhood, free trades. So what do you think? When something is free, you are the product. Well, duh. So is that fair? Well, yeah, it's perfectly fair at that point. It's perfectly fair because you're getting something in return. You're getting a free trade. You're selling some information by saying, I'm going to buy this, and they're going to try to shave a penny or half a penny or 2 cents out of your trade for them, but you don't pay the transaction cost. You get it for free. Now, if you're paying all the fees for your trade, then the selling of the order flow is completely unfair at that point because, hey, I'm already paying for this and you're selling my data. I don't like that. But if I'm getting it free and you're selling my data, well, what did I expect, right? Would you define inflation? I don't think I would define it any differently than any economist. It is a general or a broad-based, not a general, a broad-based increase in the general price level. So let's say that you have 1.5% inflation across the board, but only 2 categories are really going up. That's not inflation. That's not broad-based. That is prices going up in certain areas, but it's not broad-based. So that if you control for those 2, you find that you don't really have inflation. You want to see in the CPI report, if you scroll all the way down, you get to these different indexes. All items less food, all items less energy, all items less food and energy, all items less food, energy, and housing. You get goods less vehicles. You get vehicles less tires. You get all of these sub-indices. And you can look down the side, and if they're all very low and a couple of them are high, you don't have generalized inflation. You have specific inflation in particular industries. But if they're all high, all those sub-indices that control for everything, if they're all above 2%, then you have broad-based inflation. So inflation must be, number one, broad-based. In fact, it's affecting a lot of things. And you have prices increasing on a broad base, generally across a bunch of categories at a rate greater than, well, if we call it inflation, greater than 0% would be inflation, and less than 0% would be deflation. If you were to start a business or invest in a business in Canada, what sectors would you find interesting? Well, I find the education sector interesting. So it would be, I would be investing in that space if I were going to do something there. I don't know if it should be something I find interesting. If you're going to start a business, what do you find interesting? Because there's going to be some dark days and some dark weeks and some dark months where, everything tells you should give up, but something has to push you on. So you better love what you're doing. You better enjoy the industry that you're in. You better understand the industry that you're in. So it's on you to figure out what you want to do. And you don't need a world-changing idea. You just need to be better than anybody else at whatever it is you're doing. What part of the economic cycle is the USA in right now? I'd say you're in 2 different phases, depending on on where you end up in the income spectrum. Let's just cut it in half. For the bottom 50%, you're probably in a slowdown or even a contraction phase as far as how they feel where they are. And in the top 50%, you're probably in the late expansion, early slowdown phase. I think what you call a recession depends on what's happening to you. Like the expression is, when your neighbor loses their job, it's a recession. When you lose your job, it's a depression. So, I think you have to look at, if you split the population, I think you could probably do it cleaner. The bottom 50% probably feel that they're in a slowdown to a contraction, and the top 50% probably feel, late expansion, slowdown. So in a previous video, you are a classical Which thoughts of neoliberalism you agree with? I disagree with any ideology that suggests that you've inherited evilness. I disagree with any ideology that suggests that we should think about people in terms of their skin pigmentation or their gender or their sexual orientation. I disagree with all of that. And if you look, especially even on LinkedIn, you see it, these neoliberals so proud of the decisions they make. They hire, somebody of a certain skin pigmentation, and they got a picture up right away of the person they hired for their own glory. Who would do that? Who would even think to do that, right? Except a fake liberal. A fake liberal would never think to do that. That's why I've called Trudeau a fake liberal for years, because from the get-go, he wanted to point out everything that he was doing. And if you didn't praise enough, point out that you praise him enough because you didn't recognize choices he made. That's a fake liberal. Who would think of doing that? It would be like me going on LinkedIn saying, I breathed today. I breathed all day. Why would I do that? Of course I breathe. I'm human. It's not interesting. So if your natural proclivity is to look past all of those things, it never occurs to you that you should say, look at the choice I made. Look at the choice I made. I'm a pretty good guy, right? Look what I hired. Look at my minority. Look what I've done. Like Trump did in one rally. He's looking for his friend, his African-American friend. He points, he goes, he's over there. Look at my African-American. Look at my African. Google that. Look at my African-American and watch the way he does that. But if you're pointing this stuff out, I have to ask if this is really who you are, or if this is what you want other people to see you as. I find that the liberalism today is not about being a certain way, inherently being about a certain way, but is about making sure that other people see you in that way, that it's much more performative, that you're performing liberalism for other people to see, but you don't really know what it means. It's just not innate to you. You don't make decisions that way. You have to really think about it and how it's going to look and what the PR is going to be and how you can use this to demonstrate some things. The idea of me publishing anything for my business on diversity or inclusion or equity, I would think, but why? It would be like me saying I breathe. I mean, I do things because it's natural for me to do. I don't look at certain things, and I honestly, I really don't care about any superficial features. I've met some white straight men who are complete freaking assholes, right? Just because you are of a certain skin pigmentation, gender, and sexual orientation doesn't mean you're any better than anybody else. And I've met some wonderful people with different sexual orientations than me, and I think, I don't care. And I've also met some people with different sexual orientations that are complete assholes as well. Not every gay person is a nice person. They can be assholes too, right? Look at the character of the person. That's classical liberalism. Look at that. Let people live the lives they want to live. Let people believe what they want to believe. You can have conversation with them without demanding that they participate in your belief system with you. That I have no patience for. The moment you demand that I participate in your belief system, if I don't believe you, I'm not going to be ignorant or rude. I just don't believe what you believe. I'm an atheist, but I don't go around hitting people over the head with my science textbook, right? If I had friends, and I do have friends who are religious, but if they hit me over the head with their Bible every day, they wouldn't be my friend for very long. Live and let live. That's what I think. All of these beliefs and superficial markers of identity are absolutely useless. And I think that's where liberalism has gone wrong, by elevating those things and saying we should pay attention to these things. You have gone back 100 years in progress by doing that kind of thing. So I don't agree with the modern day liberals. the performative liberals. It's the moment you start crowing about how wonderful you are, you're not. What's that? I think Margaret Thatcher said, if you have to go around telling people that you're a lady, you're not. I thought that was a good line. She had a lot of really good lines. CFA related question. Why do we add the cost and subtract income when valuing forward contracts? Well, imagine that you have to borrow money. Let's say I'm going to sell you this car for $5,000 today. And somebody says, I'll tell you what, I'll give you $6,000 in 1 year. Well, you got to do some calculating, right? You got to say, okay, well, what if I borrowed $5,000 and bought that car? After 1 year, what would I owe the bank? And let's say it's $5,500. You'd say, I'll do it. I'll sell it to you in a year for $6,000. Well, the interest is the cost. You borrow $5,000. In a year, you get $6,000. You pay back $55,000. You made $500 free dollars. Well, that can't happen because people will start to bid up the price of the car and bid down the price of the forward until you can make no money. And that would be the forward price. But let's say you bought it. Well, now you got to store the car. It's going to cost you $20 a month to store the car. So you figure, well, it's going to cost me $240 to store the car. So it'll cost me $500 in interest and $240 to store the car. I borrowed $5,000. So at the end of the period, I got to pay back the $5,000. I got to pay back the $500 in interest, and I got to recover my $240. So I got to get at least $57.40. So now the forward price is $57.40. But what if it was a particular type of car that people wanted to take pictures with, and you could charge $5 a picture? You'd say, but I get some income during the time that I own this. So if I get some income at the end of the year, I don't have to recover everything because some of my income helped to recover it. That's why we add the costs and we subtract the income. What's your take on TD for the next year? As a bank, yeah. I mean, it still has a franchise as a bank and it's a good bank, but it's got a problem. How much is that going to cost shareholders? Uncertain. How much is it going to cost? Now, it's a one-time event, but what if this one-time event comes with a fine and a restriction on activity? They can no longer be in this sector or do this for the next 5 years. That is possible. Well, that does take away some of the value of their franchise. So it's got an uncertainty. That's why it's sold off. That's why it's selling at a lower price. The question you have to ask is, does the lower price justify the uncertainty? What sources did you say you used to do your taxes better than your tax advisor? You can find, so the CRA puts out a lot of information and a lot of instructions on how to get everything done. And they have a lot of information on their website on every single line item, you just have to read it. You just have to read it, and you go slow, line by line by line. And sometimes you'll get to a line that says, see Schedule 3. You go to Schedule 3. You're working on Schedule 3. It says Workbook A something or other. You go to Workbook A something or other. You're going through those lines. So it's this recursive thing where you got to go to the workbook. Then you take numbers over to Schedule 3. Then you take Schedule 3 over to the line. So it's amazing how many schedules and workbooks there are. Lots of schedules depending on the complexity of your income. You can have up to 9 different schedules that you have to put in there. But it's line by line. It's just line by line. Now, if you work for somebody and you get a paycheck, and at the end of the year you get a T4, and that's your only source of income, there's really not a lot to figure out. All we have to do is figure out how much you gave to your RSP, and there you go. What's your basic exemption amount? Did you pay rent? How much do you owe in your for your health tax? I mean, there's not a lot to figure out. But when you have income from multiple sources, self-employment income and investment income, and you own assets in different countries, well, the complexity just jumps straight up. And there are schedules and workbooks to do. It's line by line, much like a 10K. You start reading till you hit a word. You go, well, what does this mean? Well, I'm off to Google. I got to figure this out. And that could take 5 minutes. It could take 5 hours, right? And then you go back where you left off and you start reading again. Okay, I don't understand this. You're back to Google until you get it. And it's just a recursive process like that, line by line. So the first line, what do I put on this line? Is it clear? If it's clear, it's like, okay, well, I know what this is. There's no debate about what this is. It's pretty objective. Move on. Do you have an ETA for the Fed balance sheet video? I'm doing the automotive one right now. Then I'll go back to the balance sheet one. The balance sheet one isn't as, I think, as interesting as the first two. The balance sheet one is really just a whole bunch of what if the Fed buys securities? Let's do the transaction to see what happens to the balance sheet when it buys securities. I mean, it's a lot of that. It's a lot of, well, if this account goes down, some other account somewhere has to move. And that's really about it. So it's more accounting based than anything. VRE be an equivalent holding if you were bullish Canadian REITs. I don't know VRE. Would the ETF have too much drag on it due to other REITs it holds? I'm only interested in Canadian apartment REITs. And I'm really only interested in InterRent, Killam, and CapREIT. Minto, but not Boardwalk. And then there's the high yield one. Northview has re-IPO'd their high yield, so it's another REIT sitting around $13-14. I haven't really dug into it to see if I like it or not. So I'm really only interested in a few REITs, and I'm really only interested in apartment REITs. So I don't know that I would be interested in a real estate ETF that had a bunch of other REITs in there. We're getting an hour and a half, so we'll finish up soon here. Looking at the CapEx of all the large caps, it's clear that spending will continue and will trickle down the AI buildup, which includes chips, but more importantly, the infrastructure. Oh, it continues on. The infrastructure building out data centers. Have you looked into a data center play as picks and shovels? I'm looking at STLR and VRTS2, which specialize in building racks and liquid cool. I haven't looked into those. No. Out of 136 sub-industries, it's there's always one that you've never been to. Well, I wouldn't say always one. 100. Is it true that when rates are rising, you want to invest in capital-intensive industries as early as possible because the replication cost is hard to do when the cost of capital is much higher? I can see the argument there, but no. Capital-intensive industries tend to have high operating leverage. And if you're raising rates, it tends to slow down economic activity. And because they have high operating leverage, a small change in revenue is a large change in operating earnings. So no. And typically, if you're capital intensive, you're usually durable goods, automakers, construction, something like Cat or Deere, heavy equipment, mining, for example, tend not to do well usually when rates are rising. So you can say replicating their capital base would be expensive if the cost of capital were higher. True. But the operating performance under high rates is lower. So it's a trade-off, right? So no, I don't know that I would say that would be a good thought. I want to run my own portfolio someday.
currently an analyst at a family office with some experience in asset management. How much capital do you think I need to manage my own portfolio full-time?
Depends on your lifestyle cost. So if you want to replicate $100,000 a year and you think that you can, without taking a lot of risk, without, swinging for the fences, you think you can do 15% a year with different strategies. Divide 100,000 by 15% and see what you need as your capital. What does that put you? Somewhere around 600,000, 666,000 to get 15%. If you need 200,000 a year and you think you can do 10% a year, you need 2 million.
If the Fed moved to the zero line, when, not if, when the Fed moves to the zero line, couldn't the Treasury just issue heaps of low-cost debt to minimize the drain on the economy? And then the next time inflation returned, they could keep their head above water?
The Treasury cannot issue any more debt than they are authorized to by Congress. So they have to finance the government. That's all they're doing, is financing the government. So with that, they can then determine the maturities that they would like to invest in, and that's all. You're issuing bonds with very high coupons right now. If interest rates go down, the price of those bonds really go up. You can't afford to buy them back. You're not going to buy them back. You're going to have to keep paying that coupon over time. While the short end of the curve drops, you're rolling over your short dated maturities at lower and lower rates. But as those are dropping, the price of the long dated bonds are increasing. You're not about to buy them back. You're not going to do that. So it is a slow moving average.
Yeah. And you have to understand the clientele effect in each market. You can't overwhelm the money market industry. You can't starve the money market industry. You have to be able to balance how much money goes in there, how much money goes into the capital market, and where on the capital market curve it goes. I'm cautious on beta, although not as bearish as you. Do you suppose XLU is a good candidate for some beta exposure given the rate cut outlook? I do. I think utilities are in a great place for the next 3, 4, 5 years. Nice big fat dividend, and with regulatory assets set to increase at a rate of 6 to 8% every year, you're going to get a growth in the dividend on average of 6 to 8% a year. Yeah, I think for long term low beta, I like utilities. In the next market outlook, could you go through how private domestic final purchases are calculated?
I'll put that in the applied level. I'm just finishing up the CPI one now. And in the applied level, in the top down sector, I'll put, half hour videos up, half hour, 45 minutes of as many economic reports as I can. The first one I think is CPI, then I'll do PCE, but how to read the CPI report, what are all the tables doing? And some of the tables are really interesting. Usually we never go past the first table, but as you go deeper, depending on what industry you're playing in, some of those tables can be very useful. So I'll go into the applied level. Using max leverage on residential real estate is a good idea. Not at the cost of leverage right now. I wouldn't do it. Not at the cost of leverage. If you want leverage, try to create a synthetic position. That's better than leverage. You're going to get better leverage out of it, better borrowing cost out of it than if you used your broker's money, and you'll get a higher leverage ratio. So the interest rate you'll pay on a synthetic right now, because it's in the price of the call and the put, the interest rate you pay on a synthetic is SOFR
for that period of time. You're never going to be able to borrow at a lower rate than the interbank rate. You get the interbank rate built into the derivative. If you're going to use leverage, use a synthetic. Buy a call, sell a put. Streaming skipping for anyone else. It shouldn't. I'm on my fastest internet connection. By the way, I'm only here for 6 more weeks. Then I'm back in Canada for 3 months, maybe 4. I'm allowed to be in Canada up to 6 months less a day now. And I still have a house there, and there are no mosquitoes where I live. Well, I shouldn't say none. There are, but I rarely get into a fight with a mosquito. Here, I get into a fight with 15 mosquitoes every minute. I'm tired of that. So I will be going home. So I'll get faster speed. So the stream is skipping, it seems. Somebody says, refresh YouTube. It's working when I do that. Thanks, refreshing fixed it. Okay. I'll stay in the game a little bit longer. Your short beta thesis based on something breaking and causing recession, or is it mainly a valuation concern? Mainly a valuation concern. And I'm using it as an extension strategy. So having some short beta allows me to extend long beta where being at the valuation levels we are, I may not normally feel comfortable extending my my long positions. How can I maximize the small investor advantage? You mentioned your applied series, 25K US to invest, high risk tolerance, 80% in buy and hold, 20% into that smaller investor advantage portfolio. Well, if I'm holding something, I don't mind selling calls against it if I think the upside is limited. I do a lot of put selling on stocks that I think just aren't going to go much lower, but certainly aren't going much higher. Some I simply just buy. I'll do a combination of buying and selling puts. Some I'll just sell puts on, which is, I find, capital efficient. It's hard to do that at scale. Like with AT&T, selling the $17 puts is nice, and I think it'll be profitable for quite some time. But if I were an institution and I needed to do 10,000, 15,000 at a time to move the needle, that would be hard to get done. The volume really wouldn't be there. It would be hard to get done. Any updates on your income factory position on T? Still selling at the 17 level? Yes, I am. I'm still selling at the 17. The 16s and the 17s. I got the 16 sold for May. I got the 17s. I believe I have the 17s for June. Let me check. I know it sounds like I can't remember what I have, but I do quite a bit. So I got 2. I got the May 17 and the May 16 puts. 17 puts, but I want 70 cents. I'm not getting 70 cents, but I want 70 cents to do it. If I don't get 70, I'm not that thrilled about it. So I'm willing to wait to get that done. And there, I'm trying for 100 of those as an initial position. Seems that the easing tensions in the Middle East have had more impact on XLE last week, despite a decrease in oil rig count. Do you believe XLE still has potential to rise? Yeah, I do. I think with more consolidation in the industry, the bigger ones buying the smaller ones, they will shut down wells. I think that has value. If the price drops to too low, OPEC plus will cut again. They will, because they realize this is the last run. EV is inevitable. I think it is inevitable. I don't think it's ready just yet. I think there's 3 or 4 year gap where things have to get a lot better and they have to get a lot cheaper, or internal combustion has to get a lot more expensive because of the increase in regulation coming that will raise the cost of those cars. But 20 years down the road, I do think that we will be living in a mostly EV, mostly autonomous world. 40 years down the road, which I probably won't be around to see, but I think you step out of your house and you step into a pod that is a car that it just has seats in it, no steering wheel, no nothing, and it just takes you to where you want to go, and you get to continue doing work, watching TV, doing whatever you want at that time. I believe that is the future. I don't know how profitable that future is going to be for any one company. Just because I see autonomy in the future doesn't mean there's one company that owns it all. I think that it'll be just a standard feature, like, for, you know, a car has, yeah, I think that'll just be something in the future. I believe that any oil company right now sees this as this is the last 20, 30, 40 years it has for good money. And I think it's going to, you know, those free cash flow yields are going to be fantastic. Any new positions this week? Yeah, I put a short on Tesla with a risk reversal. I bought more ABR on the market, covered before the Fed, and then re-entered back on Friday on futures at 5,200, September 5,200 short. I'm looking at Goodyear Tire. I like the $12 puts. If you look at their chart, they've been an $11 to $13 stock for a long time, and they got pretty decent premium at the 12. So if there is going to be more EVs on the road, EVs go through tires twice as fast as internal combustion, just because of the weight of the vehicles. They go through the tires twice as fast. You could have 100% increase in tire volume, you know, in 10 years, 15 years. Something I'm looking at. Don't know. I don't know yet. Just watching it. Probably start with selling some $12 puts, getting a feel for how it moves. Assuming you're right on the interest rate environment going forward, would healthcare insurance companies perform well? Well, I don't know that they're interest rate sensitive as much as they are demographic sensitive. Utilization is seeing a boost since COVID, meaning more claims. Yes, I don't know why. If you have more claims, why would you want to be in insurance? All right, that means you're paying out more. No, I'm not sold on healthcare insurance. Will you sell more Newmont 3750 if there's weakness this week? I will. I am looking for it. I've been watching Newmont saying, come on, one more run to 39 or 38 for me, please. That would be nice. One more run, please. Oxy reports earnings this week. I see weakness down to 60. Yeah, I'm back in the game at 57.50 again. I'm looking for that. You know, we'll see what happens. Could you talk about why you are shorting via just a futures contract? Why not use bear spread instead for defined risk? I don't want defined risk. Defined risk is defined reward, right? I don't want that. I want full beta exposure on this, so that I can use an extension, that I can extend my long positions without having to worry about having call spreads because I got bear spreads. I want the right amount of short beta to extend my long beta. So I just don't like the spreads. EV from an insurance perspective this weekend mentioned fewer accidents but higher costs. And FSD transfers insurance costs from operator to the vehicle. Well, yes and no. Yes and no. So you have a vehicle that gets into an accident. The lawyer right away is going to sue everybody. The vehicle owner doesn't escape.
The insurance company does get sued. The insurance company does. But the bigger money is with the vehicle manufacturer. They're going to get sued, absolutely. A lawyer never just sues one. A lawyer sues everybody because some people will settle. That's called a nuisance suit. Some people will settle, but you never just sue one. You sue everybody that's involved. I did not. There was one situation in which I had a clear case against somebody and I was going to sue them. But to do it, I had to sue somebody else. So I chose not to. And I said, can we just not do that? And he said, they're going to be cross-sued anyways. They will be cross-sued. The other side will sue them anyways. We may as well sue them friendly. Ever hear of that before? Sue them friendly? Because they're going to be cross-sued anyways. So I didn't go through with it because the third person really was an innocent person in the whole thing. But lawyers sue everybody. So it's. I don't think it's really true that the insurance company doesn't get sued. They do, but the big money isn't with the insurance company. The big money is with the automaker. But if you were operating that vehicle as a commercial vehicle, that's a different freaking story altogether. Because now you had a bigger liability than if you just hit somebody else or killed somebody else in the vehicle. You got a bigger liability. The insurance company, when they get sued by the lawyer, will cross-sue the manufacturer and say it's not our fault, it's their fault. So there is a cross-suit there. It doesn't end with the insurance company. But if you were operating as a commercial vehicle, the insurance company would be like, well, now we're on the hook for this because they insured a commercial vehicle. There were passengers in this vehicle. The insurance company is responsible for that. So that's why I don't think robotaxis are a thing. So he couldn't talk to the robotaxi issue. Every company that is operating a robotaxi right now is self-insuring because, well, they're big enough to self-insure. Fewer accidents, yes. Higher costs to repair, yes. FSD right now transferring it to the operator is only because that's where the money is. That's not going to last forever. I bought a SPY mutual fund through CIBC, a TFSA account. I just heard about some withholding tax in the TFSA. Yep, there is no tax treaty with the TFSA. So the withholding is 15%. Have I made a mistake? Can I transfer the balance in an RSP account? In an RSP account, you get the full. You would get the full dividend. Your TFSA should not have currency risk in it, and now you do. You should not have currency risk in your TFSA, and you do. You really should stay with Canadian assets in your TFSA account, and you really should stay with in the TFSA because there's no tax. You should stay with REITs, especially residential REITs. They're going to be hot for a long time. They have a very good yield, and the nice thing about it is the company doesn't pay tax on the income, and you don't pay tax on the dividend. It is no tax all the way through. It's the best kind of income you can make in a TFSA. I would not have taken currency risk, and I would not have taken a U.S. ETF because now you have tax and now you have currency risk. Two things I wouldn't want. If you had started with around 50K annual contributions of 5, do you think it would have been possible for you to achieve what you have today? Well, two things on that. Possible to achieve the dollar value I have today, or possible to achieve the returns, the percentage returns over the years? Percentage returns, yeah. Dollar value, no. If you remove the sale of the business, the sale of my business, then yeah, sure. But including that, there's no way. No. I mean, you would have to have bought a lottery ticket. By that, I mean like some stock at $1 that went to 100 to get that done. So no.
not without some form of wealth creation that you're involved in. Have you decided on your comfortable leverage ratio for selling puts? Remember, you said that they aren't cash bond covered. Do you have liquid stocks collateral that come? Well, at these high levels of interest rates, I always have cash hanging around, well, cash equivalents, but you always have cash hanging around at these rates. Well, you're getting 5.5 guaranteed. Guaranteed. Why wouldn't you do that? Why wouldn't you do it, right? I don't know if you're going to get 5.5 in the market from here to the end of the year. That means the dividend and the market would have to go up. What if it goes down 5%? I mean, there's no guarantee you're going to get 5.5%. You could get more, but you could get less. Any thoughts on the US yen? If the BOJ preventing the inevitable, or is there a scenario where they can wait it out until the currency can prop itself? I don't think it can. Don't look for them to raise interest rates. The way the yen gets saved is the sooner the Fed realizes it has no choice but to go back to the zero line. This thinking that rates are going to drop, but they're not going back to pre-pandemic levels is fantasy. Given the sheer level of debt that's been added over the last 5 years, just the sheer amount of debt and the fact that there is no end in sight to deficits, which means the debt's just going to keep going up. You cannot just go to 3.5%. You can't. If you have 3.5 with an upward sloping curve, that means you may be putting the 10-year out still at 4.5. Can't get that done. You're gonna have to go to the zero line. There's very little choice. Either you significantly raise taxes and balance the budget for a decade at least, or you go back to the zero line. They will go back to the zero line because they don't control Congress. They don't control spending. They don't control the budget. They just control the interest rate. That's all they can do is warn, say, look, this is making our job harder. But in the end, if there is this belief that we can deficit spend forever, well, then there's a belief that interest rates could be zero forever. Money would have to be free. It will have to be. That's how the yen gets saved, is the interest rate differential between the two shrinks to nothing. LAC has a deal with GM, which made an investment in the company, which will lithium for their batteries. Okay. He also said that he didn't mind paying taxes on profits. Well, what are they going to say? What are they going to say? What's a public figure going to say? What are they going to say? Right? I bought SoFi. Should go back to $8 with 2/4 of profits with upgrades over 8. I don't know what that means. Should go back to 8 with 2/4 of profits with upgrades over 8. I don't know what that means. You might be speaking in text. So I would have to be some 30 years younger to understand it, I guess. Okay, I'm going to skip these ones here. Michael Anthony. Let's just skip those because I can't understand them. Where are we? Almost 2 hours in. Let me scroll to the bottom and work my way up. So get some of those in. I'll get about 4 or 5 more answers in. Also, do you still like Font Hill? Would you consider moving somewhere with more people like Oakville? No, I would not. Just curious for your house in Canada. Do you have friends, family to look after it when you're gone? My neighbors. My neighbor's son lives in it, of which I don't mind. Good kid. Really responsible kid, and my neighbors are good people. So I mean, I really don't mind that. I live in a condo in Toronto, but very curious about house life. Also, do you like Font Hill? Yeah, I would not move to a busier city at all. You couldn't get me. You couldn't pay me, and you gave me a free condo, I still would refuse to live downtown Toronto. I'd say thank you, and then I'd sell it. But I still would refuse to live downtown. If it was, I'll give you a free condo on the condition that you live downtown, I would say, you can keep it. Thank you. But you can give, if that's the condition, to sacrifice my life to live in that, no way. I hate even just going to Toronto. I really do. I hate it. Yeah, the implied volatility on T, it has been dropping. It has been dropping. I don't know if I did that. I don't know if by saying it that so many people started doing it started for the IV. Maybe I should keep my trades quiet and only I do them. I don't. Coming to Costa Rica in a month. Would you ever be open to a lunch? Yeah, I've met quite a few people who have come to Costa Rica. I've met quite a few. But I'm leaving here 19th. It's May 5th. I'm leaving on June 19th to go back to Canada for 3 or 4 months. I am not staying here in the rainy season. We get rain straight up. I'm out. Not me. No way. No freaking way. Walking around itching yourself every second. No. I grew up in Timmins, okay, way up north. I'm a mosquito. Paid due. Black flies and mosquito. I paid my due. I fed them for 19 years of my life. I'm done. It's somebody else's turn. I'm not sticking around for that. Especially the ones down here, where dengue fever is a real thing. If you're all over the place, I'm out. Dengue fever, mosquitoes, okay. Plane ticket, please. I'm gone. I have a choice. I don't have to stay here. I'm gone. All right. Given that we're at the end of the rate hiking cycle, are you looking at agency? I own agency. So yeah, I own agency. I love that dividend. Love that dividend. They just keep paying it. Asset allocation, other than stocks and bonds, what other long tail areas to allocate cash to? Well, it depends on there's no one answer for that. I've said this many times. It depends on you. Depends on your age, depends on your goals, depends on your investment horizon, depends on your risk tolerance level, depends on your need for liquidity. Depends on a lot. If you're 25 and you don't need money till you're 65 and you don't mind putting money into illiquid assets for 20, 30 years, I would strongly suggest collectibles. There's a lot of good collectibles that you can go into, especially in the sports field. Just sports cards, even comic books. I'd suggest something in the real asset space, but again, you're in illiquid assets. And you have to get comfortable with a 20 to 30 year holding period. One of the biggest regrets of my life when I was 12 or 13 is I sold both my comic book collection and my hockey card collection. And I was a collector of hockey cards I started buying them when I was like 6 years old. I had, I think at that time, 30,000 hockey cards, but them being worth anything was never a thing. It was more of a collectible for me. But I think of all the rookie cards in those years that I had and what they would be worth if I just had put them away, because I think I sold them all for like $15 at the time, because I thought, I'm done collecting cards. It was fun, but now I'm done. Same with the comic books. And I can remember some of the ones that I had in there, like what they would be worth today if I didn't need the $15, if I just had patience. But if you do that and you're willing to hold it for 20, 30 years, it would probably be a fantastic investment. I would look in the real asset space. If you're young, if you don't need the liquidity, if you say I'm 25, I don't need this money until I'm 55. Even just with sports cards, you can dedicate $5,000 a year to sports cards and do pretty good. You can buy the whole series every single year. And then you never open them. You just leave them there. You got the whole series. You just keep putting them in a nice dry area, and you just save them up over time, as long as you don't need them. but yeah, there's a lot, like to say, what should I put money in? So many questions I would have to ask first. So many questions. Let's see. Question about understanding gold mining. You mentioned market cap to EBITDA. I've never seen this used. Seems it should be EV to EBITDA instead for cap structure consistency. EV is the normal one. Market cap. Maybe I'll have to review it again, but maybe I was talking about for the shares, as opposed to valuing the company and then subtracting the debt. It could have been a multiple for the shares. With EV to EBITDA, you have a multiple for the company that does control for capital structure and cash. It does control for that, but then you have to, out of EV, take out the debt. And then divide by the number of shares to get the price per share, or take out the debt and you have market cap over EBITDA. So EV is a company valuation, market cap is an equity valuation. If we're looking at comparing on the value, on the equity value, again, I'd have to review to see in what context I put that in. Have a loose theory on how people feel about their position in the economy. If you earn less than your country's GDP, probably feel squeezed. There's no excess. You have to go without to get ahead. Okay, so how would I push back on that? I would say that people rarely, I think, evaluate their position based on some benchmark. Very rarely do they do that. They usually evaluate their position based on how they did last year and how well they're doing at any point in their life. So if you take someone who's never earned a lot of money, who suddenly gets a job that pays them significantly more, but they're still making less than the average, than what the average income would be. If you think about GDP divided by population, they would still feel like they're doing really great. They'd feel really good about their position because relative to their past, they're doing great. Take somebody who was making $500,000 a year and lost everything, is now making $80,000 a year, making more than the average. They don't feel too good. So I don't know that we evaluate things versus a benchmark as much as we evaluate things based as a trend in our life. Has our income been going down or has our income been going up? If it's going up, I don't think it matters where you are. You'll feel better than if it's going down. So it's, behavioral finance has a bias for this as well, is that losses hurt more than gains of the same amount. That losing $10 hurts more than winning $10 feels good. So I think you have to take into consideration starting positions and what did you make last year? What are you making this year? I think is a better predictor of how you feel about the economy than where you are relative to some one benchmark. Right. Okay. Did you get more CARUN? I'm still at 28,100 shares long. I have sold puts. But no, I couldn't get more. I got 145s for July. I sold the 45s in the money puts. Those are doing nicely. And I sold 46 42s because they didn't give me my full order, ding, ding, order partially filled, order partially filled. You know how IB does that? Order partially filled. And I didn't get the whole thing. I really was hoping for some kind of bad news on interest rate front and some kind of real washout where, it dropped to $41 or $40 or even $39. I would have bought 50,000
on the spot had I seen that price. And that TLT would have dropped to like 85. I probably would have bought 10 or 20,000 at that price as well. But sitting at 44, 41. Yeah, I'm up. Yeah. Have you ever seen anyone unhappy that they're up? It's because I wanted more. You know, I got a good position, 146 puts, 28,100 shares. But I really was hoping for somewhere around the 50 to 60,000 share position on this one. So I'm a little disappointed I wasn't more aggressive. But hey, fingers crossed, maybe we'll have a big sell-off this week. Here I am cheering to lose money in the short term to outperform in the long term. But I'm in the game. I'm doing okay on those positions. I just would have liked to have done better. Okay. Let's call it here. That's 2 hours in, 7:22. It's dark outside behind me now. 7:22 here is 9:22 in my old time. I'm still on my old time. I mean, in about an hour and a half, I'll be going to sleep. I usually wake up here around 4 in the morning, which is 6 normal time. I can't adjust. I'm still on my old time, but that's okay because markets open 7:30. So the markets are still on the old time. I'll stay on the old time as well. That's it for this week. Oh, by the way, in the description box of the video this week, the Market Outlook, you'll see that there's an Instagram and a X link. I will be using those accounts only for updates to the applied level. So when I put a new video in there, I will put it on both Instagram and X so that you get it. So you only need to subscribe to one or the other. It's not as if one's going to have something that the other one doesn't have. It's just the easiest way that I can reach everyone and let them know that something new has been added to the applied level. The CPI video will be up this week, I think, and the automotive one sometime next week because I just have to go through Tesla and then do my screens, narrate it, and that's it. It's not a hard industry to figure out, really. I think it's an interesting industry going forward because a lot of changes are happening at the same time, but if you didn't have it, it's not a hard industry to figure out. Anyways, I'm going to log off now. Ciao. I got to find the end. Oh, there it is, end stream. Okay. Will there be an option to get email updates? No, not really, because it's not my site, right? It's listed on markmeldrum.com. It's not my site. I can't use their email service because that costs money. So this is the way I have to do it until I, figure out if I'm staying at that site or if I'll be moving the applied series to another site. Anyways, ciao.